this is my colleague Sam. We're here today to talk to you about our latest income plan, Launch 64. So we've run with a few of these products before, and I'm sure a lot of the viewers will be familiar with it. So it actually offers this time the greatest income per quarter we've actually achieved. So 2.1% every quarter, so long as the worst performing of the Euro stocks and the FTSE hasn't fallen by more than 20%. In addition to the income, there's actually a 60% European barrier. So at maturity, again, if the worst performing of the two indexes hasn't fallen by 40% or more, you get your initial capital back in full. So there is actually a possibility for the plan to end within 2 years and then quarterly from then on. So this is a kick-out feature whereby as long as the worst performing of the indices has risen by 5% or more, the plan actually finishes early and gives you an option to reinvest into a new edition, which might be available at the time. So Sam, why would the kick-out be beneficial to an investor?
That's a good question, Ryan, actually. Because it's a 6-year term, often investors feel like they might be locked in for a bit longer than they actually wanted. But with this added feature, it provides a bit of flexibility for the investor. Also, with interest rates and a bit of uncertainty at the moment, it means that if the interest rates were to rise over the coming years, product terms actually may improve. And if this plan then kicks out after 2 years, you may be able to get better terms on another plan.
So are there many other products in the market with just two indices that can offer 2.1%?
Well, it's one of only few dual index income plans. There are a few guaranteed income plans, maybe some stock-based income plans, and I think it fits somewhere in the middle in terms of how you apply your risk weight into a structured income plan. You're not going as high as to say, I want to base the worst of some stocks, but you're also not going as low to say, I want guaranteed income. So it fits somewhere in the middle, and that's reflected in actually the headline rate of the income.
So if we were to guarantee the income, obviously in this product there's a nice 20% downfall. You can still achieve income. Whereas if it was guaranteed, where would we be looking at for a coupon there?
I think it should be just under 5%. So you can see the difference between the two. It's almost just over about half of the coupon we're getting at the moment. So it's actually quite a big difference between the two. And often actually advisors come to us and say, can you provide guaranteed income? And when we tell them the actual rate, they're not as keen then to launch the plan.
So obviously, in order to achieve the extra 3 or 4% income per year, you have to take an additional risk. But obviously, the risk is that one of the indices is going to fall by more than 20%. But what happens if on one observation date the level is below 20% from the original, and then comes back for another date?
Well, the beauty of this plan actually is that if it indeed does drop below that level for one of the observation dates, but then actually rises back above for the next one, you'll then start to receive income payments again, although you will miss income for that quarter in which it dropped below. So even though you may lose out on one, there's still the possibility of future income.
Okay, so even if one is lost, then all is not lost, as it says?
All is not lost, right? That's correct.
Okay.
Right, thank you for watching, guys, and we'll be back soon.
Thank you.